They tend to be also listed companies of who equity, you might be an equity investor of those companies. We have to look at the company, the sector, the financials. Now, if you have 10,000 rupees in debt, then the best thing to do is park it in a debt fund. If you have 50 lakh rupees, you can put that in a PMS.
When we talk about mutual funds, as an MFD, you walk into somebody and then say 5 lakhs, 10 lakhs. And the moment the conversation comes to PMS, the ticket size starts with 50 lakhs.
But if you are not from a privileged background, if you are poor, then you will have to sell insurance or something that will generate some instant revenue. So it's made it tougher for the next 13,000 people. You do with mutual funds, everybody who is managing them has a track record, has a pitch deck, has a process to select companies. You go through all of that.
Okay.
And then you select the best according to your ability. But I don't think...
Hi, welcome to the Wealth Farmer Show, brought to you by Trackfinder Financial Services LLP. All this time, I always spoke about mutual funds, stocks and insurance. Today, one of its kind, I am going to discuss an exotic product line called NCDs, PMS and AIFs. Today, we have one of the industry veteran with 2 decades of experience in distribution services, wealth management, Mr. Manish Gadvi, CEO, Funds India. He is not only father to Raghav, he has given more than 10 to 12,000 ARN holders an entrepreneurial venture to start off with. He is a man with a vision, and he is also a mentor par excellence to thousands of business enterprises. Manish, welcome to my show. This is the first time we are sitting across and discussing something very serious. Before I start into the serious subjects, I wanted to ask you about one thing that you're so passionate about. You've been an avid reader and a vociferous persona. How did your reading and this constant learning help you?
So I grew up in an age when TV or video games or internet, nothing was there.
Okay.
So luckily, I got onto the habit of reading books, and I've read mostly something which is not related to work, so philosophy, poems, and
You're very good in history too.
yeah. So not related to work.
Okay.
But I think so. Those are things that are equally important.
Yes.
How do you lead a good life? How do you be a good person? How do you be a good neighbor, citizen, husband, wife, son, whatever roles you play, right? And it's important to read up on that because there are people who would have struggled with the same things for so many generations, right? So if you read somebody's journeys on those areas, right, probably you will be a little better than them. So I like
Very
reading about the softer aspects of life, not work related.
So basically, holistic growth.
Yeah, I like reading about things. I like to believe that I'm good at work, so I need help in other areas.
Wow, what a beautiful way of putting it across, that you are very good at work and then reading helps you learn about life.
Yeah.
Manish, you've been there, done that, and when you entered the industry, Sensex was somewhere mid of 3,000s and you have seen mid of 80,000s as well. So this trajectory of growth, did you ever visualize it?
I was, young, fresh out of college when I joined the industry in 2003. You're right, Sensex was around 3,500 or something.
Okay.
I'll also point out a couple of things. The entire mutual fund industry's AUM was about 79,000 crores. Entire. Now, today it's about 80 lakh crores, 100 times now. Right? But, what I knew from whatever I had read, right, was that this is a product in which the entire world invests, right, in US, everywhere, right?
Okay.
So in India, it started off in the wrong foot. Maybe that was learning curve.
Yes,
right?
UTA you are
But
mentioning.
yeah, so a lot of mistakes. There are no regulations before 1996, if I'm not wrong, right? So, but I knew it's a globally very large product, and the intentions are very clear that you manage people's money in the most cost efficient way, try to generate alpha, transparency, and stuff like that. So I knew it's a good product, because the alternative, if you are in 2003, what would investors do? They would buy insurance policies or fixed deposits, postal
Yes,
savings,
yes,
right?
that was the norm.
And yeah, so this was the best among the lot. That's what I thought, but we couldn't predict the kind of things that then happened. That in terms of the growth that we have seen, but
Yes.
structurally, from an investor point of view, I thought it was the most customer friendly product, liquidity, transparency, and all that stuff, smaller amounts. So I really like that. Yeah.
Okay. So you saw it through technically.
Yeah, I mean, I like the product among the available alternatives, and I thought it will do well. Yeah.
Wonderful. So I know you're not in the business of predictions,
Yeah.
but if I have to ask you a little on those sides, so where do you see Sensex by 2030?
I would say that, rather than predicting where it'll be, what you have to remember about equities is that that's your best bet if you have long-term money,
Okay.
right? Among all the other asset classes, right? Debt, gold, real estate, and let's say equities, right? Then equities is where you will probably make the highest amount of money.
Okay.
So that's why your long-term money should be in equities. Now, how much and why, that can, you can arrive at
The
that.
compounding factor.
Yeah, but it is the asset class which will compound your money the fastest, the highest in the long run. So rather than predicting with numbers, I think so you should know that's why you are in equities,
Okay.
and so it will be the best compounding asset class among all the other asset classes.
So that's quite a huge transition. If I have to look back, you spent almost 20 years with NJ India, one of the largest distributor, and one day you called that, let me change the way advisory and the business is run, especially the distribution business. How did that transition happen, and what made you feel that okay, this is the platform where there is enough room for me to excel?
Yeah. So my previous journey, was, how do you bring customers' money or investors' money into SIPs, into mutual funds, and which meant that stop that from going to an insurance product or to a
Yes.
stockbroker or to in some piece of land which is not regulated, right, or in gold, or things like that, in uh, static investments, fixed deposits, postal savings. So by 2023, when I left NJ, right, I think so we had done what we set out to do,
Oh,
which was,
yeah, yeah.
defeat,
Flying colors, I think.
yeah, defeat every other product out there, right, by a margin. And now I think so what uh, I want to do is that the same asset management company, right, will launch an SIF, will launch an AIF, will launch a few PMS schemes, will launch a gift city product,
Yes.
right? So how do you do all of that well? It's the same. Let's say if you take HDFC mutual fund, it has a gift city offering, it has an AIF, it
Okay.
has a PMS division, it will have passives,
The,
right?
the, the complete basket.
Yeah, it will someday launch SIFs too, right? So rather than being a distributor of one product which HDFC would launch, right, I want to really look at all the products and do justice to the customer's money across the spectrum of what an AMC like HDFC would offer, rather than
Okay.
stick to one.
Okay.
Yeah. So that's what I want to do well across all these products. And I think of these products as, let's say they are ingredients. Like if you are a chef, right, if you're cooking something, you need ingredients, right?
You're right.
Ultimately, how do you stitch those ingredients together? That will determine the quality of your dish, not just the individual quality of those ingredients, right?
Yeah.
So to cook a meal, you need more than one ingredient. And that's how I look at how do I give somebody advice on some of their portfolios. We are trying to stitch asset classes, products in a way that makes sense, in a way that the customer will like.
Very, very beautifully coined, and that analogy I liked because I've seen a lot of your posts with food, and you are a foodie
Yeah, I like
by
to
far,
cook.
and but most of the time it's very simple food. That's what I loved.
Yeah.
Okay, so back to the topic. So you have seen the MFDs growing
Yeah.
under your command. So you must have noticed this landscape is still far wide open. So what is that few things? What are those few things which made you feel that okay, now I need to change this landscape?
So I think so. I mean, uh, we were thought leaders, or I was a thought leader when we started talking about mutual funds and SIPs in 2003.
Okay.
I don't know. So there's no AMFI exam also. There's no ARN number in 2003, right? We are way ahead of everybody else. So the onus is on me or us to keep pushing that baton, to keep doing what is the next best thing to do. So I
Okay.
don't have to look up to anybody else. It's just, you try to beat your own track record, and you try to do what's your mandate to do. So you be ahead, always think about customer first, learn anything that is new, adapt, be clear about why that is a good thing for the customer. And yeah, don't be afraid just because something doesn't have a track record or you are not familiar with. I mean, there are regulations around these products. To believe it's the same regulator who has framed these regulations, right?
Okay.
So you have to believe in those regulations, and you have to, and it's the same manufacturers end of the day, right? So you have to believe, and yeah, you have to really think it through. It's, it'll be, I'll tell you what the crazy part is, right? Let's say if you just sell mutual funds, right? Your life is easy. There are 50 AMCs. You don't like 20 of them, 30 of them. You have to select 4 or 5 funds from that remaining 20 that you like, right? That's an easy thing to do. But let's say if you start selling PMSs, then there are 501 manufacturers. They might
Yes.
have,
Yes.
so instead of 50, it's 500, it's 10x. If you look at AIFs, I'm sure there are like 1,000,
Yeah.
1,500 AIFs in India today.
Yeah. Close to 2000, I
Yeah.
suppose.
So, your life suddenly from 50 manufacturers grows to become, let's say, 1,000 manufacturers. And that is tough, right?
Yeah.
It's
Herculean
overwhelming.
task.
It's overwhelming to a lot of people. And the primary product, mutual fund, has done so well. Your incomes, everything has grown so exponentially
Yes.
that it would make one a little lazy to do newer things, right? To experiment with newer things. It will make one a little risk averse too, right? But that's laziness actually, right? So yeah, I mean, but if you have a partner like us, like, who will solve the research problem,
Yes.
the tech
Yes.
problem, and really curate the 5 of the best PMSs out there, the 5 of the best AIFs out there, and really help you with the narrative that how do you stitch it together. I think so. Then people will adopt faster. So, uh, I don't think uh, it's so. Yeah, it is evolving. You have to be ahead. You have to, not be afraid of learning new things. Yeah.
So think a thought leader asking the MFDs to think harder. That's the punchline I hope you
No,
indirectly said.
no, I would also, ask this question to, let's say, somebody who's done really well on the MFD side, that aren't you bored of doing the same thing, right? And yeah, sometimes people say that, boring is good, boring is sustainable, and stuff like that. But upskilling is also a thing, right? And you want to up the quality of your advice, you want to up the quality of your uh, product offering and stuff like that. So you don't stop really. You keep pushing yourself to do better. Yeah.
Manish, looking at the present situation, geopolitical tensions, and the falling rupee, and also rate cuts in the recent past. And most of the data that are available in the public domain, which is not conducive to be entering the market now as a layman investor, if I have to say it so. Uh, Tell me, 2026 and 27, is this the right time to enter or is the worst time to enter the market?
So these are not digital calls, I would say. Right? Depends on your existing portfolio. So if you're really asking somebody to increase their equity exposure, or you're just saying that you have 0 rupees in equities today, you should have 30. These are different answers, right? In the
Yes.
same market,
Yeah.
right? I would say that, yeah, there are a lot of headwinds this year, maybe 18 months down the line. But like so many crises before, right? India has come through. It has done, it has weathered all those storms.
Yes.
So I would say the next 12, 18 months are a good time to accumulate more equities.
Yeah.
If you're like too lopsided on equities, you don't have money to buy equities when it corrects, like you should have debt or something else when it corrects to buy,
Yeah.
right?
Asset allocation
Right.
is
So if
supposed
you
to be.
have some debt and all that, it's healthy to have. But yeah, so it really depends on how much, what's your current asset allocation. But I would say that the next 12 months are challenging. It can give you opportunities to buy more. It's a good time to accumulate more. Yeah.
Okay. So, this entire episode I have drafted in 3+1. The first three are NCDs, PMS, AIF, and plus one is Manish Ki Baat. Okay. So now, when I'm going to enter into the harder topics, the real topics, I wanted to ask you, is there a tailwind for equity oriented products in India?
Yeah, so massive tailwinds, right? We all know the story, young population, demographics, as not a violent country, right? So many things are right for us, right? But, given where we are today, there are some headwinds too. So you have to be a little careful of that. But yeah, I don't think it is going to derail the
The
journey
growth.
on which India is today. It's just a blip. It's a small turbulence in the path.
Yes.
Yeah.
Yeah. Manish, we are entering into the first part of the conversation, that is NCD, non-convertible debentures. It's it's basically tougher for most of the people to understand because uh, NCD is considered as an FD of the affluent with a clear margin of 200 basis points more to an FD uh, investor. So, and we have seen Adani coming out with 8.9 percentage coupon rate, and it was a super hit in the industry. Now, when I keep both of them together, FD has a guarantee and NCD doesn't have. Now, is it right to say that we give NCD to investors with a white lie that it is guaranteed? What
Okay.
is your comment on it?
So on the FDs first, right?
Okay.
The Federal Deposit Insurance Scheme, or that's what
Yes. Yeah. Correct.
it's called, right? It's just 5 lakh rupees.
Yeah, I know that.
Yeah. NCDs are of two kinds. Let's just simplify that and say. So there are secured ones, and then there are unsecured ones.
Yes.
So secured NCDs mean they're backed by cash flows or property
Okay.
or equipment, right? And if something happens to the company, the first right to those assets is of the NCD investors,
Correct.
right? The second right is of unsecured creditors, and the third right is of equity owners. So the joke is that people think NCDs are riskier than equity. Uh, I think, I mean, this is the stacking order of security, right? If
Yes.
something goes wrong to the company. So we tend to, people will learn. I think so. People have learned, investors have learned what an SIP is.
Yes.
And they were skeptical about SIPs at some point in time. ये तो शेयर बाजार है, सट्टा है, पैसा किसी का बनता नहीं है. So now with experience, I think so everybody learns with more knowledge, with more I think so. Education, everybody learns.
Yes.
It's a genuine capital market instrument for companies to raise money. Companies raise money through debt, and then companies raise money through equities. You can participate in both, earn returns from both. But I would not say that it's a white lie. I would say it's a genuine product. It's again regulated product, and it has tangible security if it's a secured NCD. And even if it's not secured, it still has higher right over the company's assets than equity owners.
A wonderful answer, Manish. This is exactly what I wanted, because most of the time when NCDs are discussed, uh, the few things sets the conversation apart. One is there is no guarantee, which most of the investors believe that every FD that they do, even if it is for a crore rupee, it is guaranteed. Technically, not like you said. It's the maximum limit of guarantee by the RBI is 5 lakh rupees. Now, very beautifully you structured and said there are collaterals
Yeah.
which gives you the guarantee that the money is surely coming back.
Yeah. So
And
it's backed by a tangible security.
yeah, tangible securities.
Yeah. And
So
I'll just, you know, some of the skepticism also comes in from the fact that, let's say, I'm used to earning a 7% return, and if there is an NCD which is offering me 12% or more, right, I'll be skeptical कि ये इतना ज़्यादा क्यों दे रहा है, something is wrong,
yeah, what's the catch?
right? So yeah, some of that also can be that I'm not used to a 12% return from a debt product,
Correct.
right? I'm used to 6-7%, and if it is double than that, I'll be, of course, skeptical about that. But again, that is experience, that is education. So people will learn. Yeah.
Okay. Now, also looking at the NCD's historical data in the recent past, we have seen some of the major companies which were rated very well by the society or the companies, and they went
Yeah.
belly up. Now, then we learned another jargon called stress test.
Yeah.
So all of a sudden, that's in the limelight. So people started talking about it. Now, as a CEO and promoting NCDs, what are the due diligence you do to pick up an NCD which you feel is right for your MFD and also your investor?
So you should have a view on whoever is the issuer,
Okay.
right? Those issuers tend to be, if these are listed NCDs, right? They tend to be also listed companies of who equity, you might be an equity investor of those companies.
Yes.
So I would say that if you don't mind owning a company which is listed and in terms of equities, why would you shy away from being a debt investor in the same company, right? So we have
very valid.
to look at the company, the sector, the financials. If there are real estate NCDs, right? You have to look at what is the security, what is the project, where it is located, what is the sales propensity of that, who is the builder. So we tend to do all of those things, right? We want to go through as much as we can.
Okay.
But what brings us comforts is that in India, I think so, because of the regulations, right, the incidences of defaults or scams are going down with time.
Yes, yes,
Right.
yes.
Every time somebody defaults or runs away with people's money, everybody learns.
Enough checks and balances.
Yeah, everybody learns. Regulators, we all learn from that.
Yeah, right.
So it's becoming more efficient, right?
Correct.
And due diligence, everything, we have processes in place to do that. We only sell stuff which I would not, if I would sell it to my father or my mother,
Wow.
only then I would sell it to my investors. That's what we tend to do. And there are enough choices, right, of good issuers, good papers that you can do. Don't need to be desperate, right? Give you a small example. most of the bonds are listed on stock exchanges and
Yes,
stuff like
correct.
that, and there are online bond buying platforms, right? But the issue which customers face is that they can't really come up with where do you allocate that money in which 10 bonds. It's like stocks only. You need somebody who will tell you to buy the right portfolio, the right credit. So
Yes.
the value is not in having tech to sell these products or make it easier to transact. The value is in how do you curate, how do you make
Exactly.
sure that everything that you offer is of high quality. So
Okay,
yeah.
so basically what you said is having money and parking your entire sum into one bond or one NCD may not be the right way to do it. You need to have a curated portfolio wherein you know the timeline of a particular amount, you know the timeline of another amount. So you are creating a portfolio which is synonymous with the mutual funds. Now it is in debt also you need to have a portfolio.
Yeah, so I think so. The only boat, or I would say the opportunity which the mutual fund industry has not been able to do much about
Hmm.
is debt, right? If you look at the entire debt AUM today in the industry, it's
Okay.
predominantly HNIs, institutions.
Yes.
It's not retail investors, and that is because of various reasons. What you have to do because of that is that you know probably have bonds directly, where you can generate very easily with minimal credit risk, very easily generate 1 or 2% extra than a fixed deposit. You can do that very easily with very known names, right? Big companies, right? Their papers you would be able to buy, and the customer will make 1 or 2% easy. But that's something which the mutual fund industry has not been able to do. So if you look at your AUM today, right, it is predominantly equities,
Yes,
and
indeed
that
so.
is the case with most MFDs, right? It is predominantly just listed Indian equities, right? Hardly any debt, right? But debt now, I mean, if you have 100 rupees AUM in equities, how much should you have in debt is a question, but I'm sure it's not more than 10 rupees today, and that is not. That is why means it's failed to bring in debt money from retail investors, and it's an
Yes.
opportunity if you do it right. And today we tend to do it through direct bonds rather than mutual funds.
Some of the questions that I was supposed to ask you about the coupon rates and the listed secondary market NCDs, you very well answered.
Yeah.
Now, one thing that I wanted to ask you now was uh, when it comes to NCDs and then mutual fund versus NCDs, you walk into an investor and then talk about mutual funds for thousands and lakhs of rupees. And when it comes to NCD, the total corpus that requires to buy one changes. Is the transition from a small ticket to a high ticket NCD? How do you ask your MFDs to handle that?
I I I would. So these numbers, high ticket, these are our perceptions, right? So if you ask a branch manager of a nationalized bank in Bombay, what is the ticket size of an average fixed deposit, right? I'm sure that answer would be in maybe 10 lakhs, 15 lakh rupees or more.
Correct.
And customers tend to have multiple bank accounts, and they tend to park their fixed deposits also in multiple banks.
Yeah, I have
So,
seen
I,
that.
so I don't think ticket size is really an issue. Now, if you have 10,000 rupees in debt, then the best thing to do is in park it into a debt fund. But if you
Okay.
have 10, 15 lakh rupees, then probably with a little bit of work, we can generate a couple of percentage points than a fixed deposit or a debt fund.
Wonderful.
Yeah.
Now there is also that's mostly because of the negative coverage by the media that your NCDs are being now blocked for a few years. Especially, it started popping up in the mutual fund portfolio in the name of segregated portfolio. So Is there any mechanism that you have in Funds India when you advocate NCDs where you see there are red flags? So you mostly avoid them.
So, like I said, right, we have a debt research team of
Okay.
about 7, 8 people
Wow,
who
wonderful.
have been on the debt side their entire lives, right? Origination side, distribution side, right? And we try to be as prudent as we can,
Okay.
right? Nobody's perfect,
Ah,
but
yeah.
our intentions are very clear, which is to generate couple of, you don't want to be like, too aggressive on things, right? A 3 percentage point difference over a 25 years, right, in a customer's life will change customer's life, right? So you don't need to be, very aggressive, but you need to be, not very conservative as well, right? Because you don't make money by not taking risk, right?
Yeah, very true. Very true.
The problem with many investors or many MFDs is that they think market risk is worth taking, right? And credit risk is not. I mean, I don't know why they think like that, but both of those risks uh, have rewards, right? If you
Yes,
take a
yes, yes.
risk, you
All of
get
them.
compensated for that. So, yeah, I would say that, you should take both of those risks and try to make more money.
Okay, so basically, what you said is credit risk, liquidity risk, and default risk are nothing more or less than the equity market risk that you face. But only thing psychologically, when you take a NCD, you believe that okay, this is guaranteed. That is a mindset people need to change, right?
Again, I would say that, I mean, I don't have the data handy right now, but in the last 20 years, right? How many defaults have you seen, right? How many accidents have you seen on equity side, right? And are the debt side defaults higher than the equity accidents? The answer is no.
Yes,
But it's like these, stories which media outlets run on aircraft crashes, right? There is a crash anywhere in the world, right? You will read about it. There'll be videos
yeah,
about it,
front page news.
though it probably happens once in 10 years, right? So people forget that how safe an aircraft is, because those other stories are vivid, right?
Correct.
So a credit default is vivid, right? It sticks to your memory. But a stock that you bought at 100 went down to 20, you
Yeah,
sold it
and still
off,
holding on to it.
or maybe you sold it off, you tend to forget and forgive it. I don't know why. So yeah, it's more of psychology at play, and more not real data.
So, Manish, this was the last question that I asked in this series. So, investors, if you had listened to this part of the story, you must have taken note of the importance of NCDs in your portfolio and why Funds India is one of the leading distributor. And like Manish said, there is a research team. There are technological advancements already incorporated into the Funds India system, which will help you understand NCD much, much better than you have ever thought about. So, leaving aside those inhibitions, leaving aside those doubts, approach all those people who are associated with the Funds India and lap up NCDs. Thank you. Manish, next part of our conversation is going to be about one of your pet product. It's PMS. Like in the
So I
initial.
mean, just to interrupt you, mutual funds, PMS, NCDs, bonds, right, whatever, right, equities, SIFs, all of these are ingredients.
Ingredients.
And
Yeah.
I'm a
Okay.
chef, so I don't love mirchi more than dhania or haldi more than garam masala. I mean, I need all of that. So just
Okay.
to
So it's
throw
all
it
part of
in.
the
I mean,
game.
yeah,
Yeah.
please,
Okay. So
please
so
continue.
I'll change that one. It's not a pet product. It's one of the
One of
best
the
product.
ingredients, yeah,
One of the ingredients.
yeah.
Okay. So now, uh, when we are entering into this, uh, one of the questions that almost me as an MFD and also as investors generally faces the ticket size.
Yeah.
So First, I wanted to ask you, when it comes to mutual funds and you are an investor, when is that apt time that you need to shift to PMS?
Okay. So, I mean, mutual funds have done a fab job of, financial literacy and spreading awareness, equity, bringing in the equity culture in India. I don't think it's necessary to move to a PMS just because you reach a certain milestone, right?
Okay.
But what you have to look at is that who are these people who run PMSs, and it's the same people who came out of the mutual fund industry
Okay.
after 27 years of experience, after 20 years of experience, and they are running these firms, right? So it's not the different guy who is now going to manage your money. It's the same person who has generated those returns in a mutual fund structure, right? Now, it's easy to set up a PMS firm
Okay.
or to get a PMS license versus to get an AMC license, right? In terms of compliance, in terms of net worth, etc. And if you look at the bulk of money, which let's say you have XYZ AUM today, a bulk of your money is also from people who have more money,
Correct.
right? 80-20 rule, whatever, right? And you know currently the data, if you look at, there's a website for the PMS
Yes, yes.
body which is called AppMe, right? If you go there, you will be able to see the performance of most of the PMSs in India, majority.
Correct.
And there's significant alpha, a lot of them have generated, right? And I mean, the real question is, why is that so, right? Why is a PMS provider able to beat, let's say, the average of flexi cap funds by 5%, 6% or more, right? My sense is that it's because there are things like hurdle rate and performance fee. So
Yes.
there is a financial incentive, for a PMS manager to generate more alpha, right? Or let's say to beat the hurdle rate, and that's not there in mutual funds, right?
Okay. Okay.
So, and these are people who have run mutual fund schemes for decades. So it's the same set of people, right? So really, you have to look at that. Again, mutual funds versus PMS is not an either or option, according to me. It's an and
Okay.
option. You're trying to cook a dish, you need everything. You have to really look at what percentage you want to deploy in a PMS to generate extra alpha, right? And what do you want it to be like a core portfolio where you are okay with, market plus 2% returns, which is what mutual funds are very good at, right?
Yeah.
So we decide, it's like an asset allocation question. How much do you allocate to each one of them? Not really think either or.
Yes.
And it has nothing to do with the ticket size or anything. You can be a very large investor, be happy with index funds or ETFs, and you can be, somebody who has just 1 crore rupees and say, no, I want to put that entire money in PMS. I want to put zero money in mutual funds. So it's really up to your risk appetite.
Correct.
And what kind of returns you want.
Probably your understanding about the product.
Yeah, yeah.
Okay. So, according to you, this 50 lakh entry, and in some cases that are much more higher, the basic 50 lakh entry is not a wall, neither it is a filter. It is about the investor's perspective. That's what exactly you wanted to say.
Yeah, so I mean, the regulations are that if you have 50 lakh rupees, you can put that in a PMS. Probably the reason for that is that probably, the number of regulations which a PMS firm is subject to is lesser than a mutual fund firm, right?
Okay.
And because it's a little more liberal in that sense, you can't let small investors, participate in that because, their expectations and, things can
Yeah,
Because
right.
of less regulation, it probably tends to be a little riskier, right?
Yeah. Someone you
So,
can park
so
the surplus
somebody
basically.
who has more money, or it's for them.
Yes.
Yeah,
So more exotic.
yeah, yeah,
Okay. So there are about 500 plus PMSs in India. 42 trillion rupees
yeah,
are already invested.
yeah.
And uh, do you see more firms coming into the market? Don't you think it's going to be a little overcrowded at
I mean,
this?
I think it's 501 is enough crowded already,
Okay.
right? But yeah, so like I said, the capital requirements are smaller, right? To get a PMS license,
Okay.
the compliance, etc., is easier,
Okay.
right? So, and there are, I mean, enough people in India who have run, let's say, equity firms or equity research, who want to run this business. So, I mean, I don't know whether 501 is more. I think it's more, but there can be another 500 people out there who think they can manage somebody's money in a better way, generate better alpha.
Okay.
So yeah, I think this. I mean, it's already 501, but I think yeah, there'll be many more.
Okay. So do you see a consolidation, like in the case of many mutual funds companies, AMCs have consolidated.
Yeah.
So do you expect a consolidation coming up in the
Yeah,
angle?
I mean, it's more of a firm level problem than an industry level problem, right? I think most of the PMS firms are pretty uh, tight in terms of the number of manpower, their
Okay.
cost. So, they might have one office, they'll have probably 20, 30 people.
Okay.
It's not like that if you are running a PMS firm, you need to set up 100 offices in India.
Oh, correct.
Most of the best of the PMS guys, or somebody who has, let's say 10,000 crores of AUM, probably they have one office, probably they have 20, 30 people working from them. So it's more of an
Very, very lean structure.
yeah, at a firm level, it's easy to manage. It's very lean already. But yeah, there can be things like the succession planning. Like, what if the person, it's more person dependent than process. So something happens to the key man, maybe somebody else can take over that,
Yes,
but it
yes.
will not be triggered because of microeconomics, right? Or
Okay.
it will be probably maybe regulatory, maybe succession planning. But yeah,
Okay, okay, okay. So economic may not the
is
growth of the economy may not trigger this one, but of course the succession plan that you rightly mentioned, or maybe another regulatory
regulation.
issue which will consolidate them. But
Yeah,
yeah,
maybe.
either way, you consider this 500 is neither overcrowded, but it is enough. But if there are more people coming in, yeah,
More the merrier. Yeah.
more the merrier. Okay. Now, when we talk about mutual funds, as an MFD, you walk into somebody and then say 5 lakhs, 10 lakhs. And the moment the conversation comes to PMS, the ticket size starts with the 50 lakhs. And also the concentrated portfolio, risk appetite, and also we use softly a word called 3 years तक आपको निकालना नहीं है. So all we put together, the room becomes quieter from there on. And then now the customer pulls back. How do you train your MFDs in Funds India to crack that particular psychological barrier?
Of a higher ticket size.
High
That's what
ticket
it's.
size.
I think, like I said, on fixed deposits, right? I mean, you live in Bombay, we all live. I mean, you've been here for quite some time, right? Whichever suburb you currently live in, right? I mean, everybody who is your customer today probably has a four wheeler, probably has his own house, his or her own house. Probably on all of that is in crores, right? He's driving a car
Yes.
which is 10, 15 lakhs. They probably go outside India once in a year. they have a lifestyle. I don't think that is more of a customer problem. It's more of a MFD problem, right? And I'll give you an example from our own history that in 2004-5, let's say if you are an insurance agent, which is where most of the current MFDs came from, right? Their background is they were
Yes,
insurance
yes.
agents or post office agents, right? They would expect a 20,000, 30,000 premium. That was the ticket size in insurance products. Suddenly, when mutual funds, they got customers who wanted to invest 20 lakhs, 25 lakhs, 1 crore,
Correct.
right? And to somebody who's used to 20,000, even 5 lakh will sound crazy,
Yeah, yeah.
right?
Such a adrenaline rush.
Yeah. So I think because predominantly most MFDs have sold SIPs and mutual funds, there is a mental barrier in their brains around this 50 lakh minimum ticket size and 1 crore. There's enough money in India. Like you said, the PMS industry is already 42 lakh crores. If you remove EPFO, still it is 15, 16 lakh crores, right? Which means that, so I don't think money or ticket size is a problem. I think so mindset is a problem.
Okay.
And that we should take comfort in the fact that whenever you started your business, you never thought you would have 3,500 customers in mutual funds, right? You never thought the kind of SIP book you have today. So here also, I think so what you have to do is not underestimate yourself first. Don't underestimate the kind of potential which is there in India and around you. People have money. I mean, we're not, not
We are not
50
third
lakhs.
world country or poor.
Yeah,
We have enough
yeah,
money.
we are. I mean, decent. So that, and there are enough customers. Yeah, looking for these things.
Tell me, Manish, how do you help? Yeah, I know you have a robust research team and a robust technical advancement in Funds India. How do you help MFDs choose the right PMS for the customer? What is the SOP that you follow?
So I'll tell you what you should not do. Right. A lot of people think of PMSs as a way to get more trail commission,
Okay.
right? And the way they think about this is that a PMS will charge 2.5% to the customer.
Okay.
They're ready to give me 1.5 of that.
Okay.
My commission in a HDFC Flexi Cap fund, let's say, is 0.60 or 0.70, right? So I can actually double 2.5 times that,
Okay.
right? If you do that, you are doing it wrong. Looking at commissions, PMSs as a way to
Make
increase your yield,
Oh.
then you are doing it wrong. So we don't do that, right?
Okay.
We think of them as, can they deliver substantial alpha over, let's say, a flexi cap fund? And there is enough track record on both sides to figure that out. So if they can generate 2-3% alpha, and if they charge reasonable fees,
Okay.
I would say great. That's how. So you look at the track record of the guy who is managing it, right? The fund manager, the team. And luckily, on the mutual fund side, like you have this data, so much data. Now there is enough data on PMSs. So there are PMSs in India which are 24 years old. There are, and enough of them have done substantially well over a average flexi
They've been
cap
through
fund.
on cycle.
Yeah, and it's like I said, it's the same guy who used to work in the mutual fund space as a fund manager, who then set up his own or his or her own shop. So you have conviction on their skills, and then somebody who is working for some organization now is an entrepreneur himself. Now, is that person likely to work harder or likely to be lazier, right? The answer is they'll work twice as hard, because now they no longer work for an organization. This is their organization.
Yes.
And there is a financial incentive to actually work harder. which is performance fees. So there are people who've done really well, and if you can, we believe we have curated our list on merits
Okay.
and not on commission or not on
Not on the performance.
performance, right? And there are, so I'll give you an example. So there is a PMS guy who I went to meet who said that एक काम करते हैं 20% तक कोई फीस नहीं,
Oh.
right?
You're
Zero
talking about
fees.
the hurdle rate.
Yeah, zero fees. But once you cross 20, I'll charge 25%. Fair? He said. I said no. Right? So he said, why? This will work. Every client will love this. What is the downside? So I said, let's say you generate 30% returns. What will you charge the customer? Because it's more than 20,
Yeah.
right? You generate 30, 25% of 30, 7.5. So I said, here you will pay 7.5. Now hear me out, right? My proposal is that you charge 1.5% till 15% hurdle. And anything above 15, you can charge 20% performance fee. Now you calculate 30% return, 15% you pay 1.5.
Okay.
Remaining 15, you pay 20% of that. So 20% on 15 is 3.
Okay.
3 plus 1.5 fixed. You paid how much? 4.5 instead of 7 point.
7. Yeah, correct.
Instead of 7 point whatever that
Yeah.
was, right? So if you think about the customer first,
So you draft it well.
so you have to think about the investor first, not your commissions. Probably I would have made more commissions in the first arrangement. Probably clients would be gullible. They will also fall for the same trick.
Yeah, yeah.
Right?
Because they might get
they
stuck
might
to
think
the,
this is free and this that.
yeah, the 20%.
So you have to really balance the three parties in a way. There is this manufacturer, or there is this PMS company who has its own incentives. Then there is a client. Then in the middle is you. So your job actually is to represent the client, think of their interest first, and not your own interest or of the PMS company's interest.
Okay. So with that statement particularly, you answered one of my questions, which was about hurdle rate and over and above the standard fees. So very, very beautifully you articulated that you walk into the PMS manager and you decide the terms for the investor. And I think if rest of the distributors also think like this, we will have an ecosystem where everybody makes money and no one ever end up on the losing side.
Yeah,
That's, I think, your.
yeah.
When we discussed a lot of intricacies of PMS and also how we relate with mutual funds, we did. But again, back to one of the, it's a funny way to look at it. But when there are 15 to 20% drawdowns in mutual funds because of the geopolitical or economic slowdowns, there are chances of the investor panicking because of overcharged emotions. But when it comes to mutual funds, and MFD says, stay invested, SIP karo, khush raho. How do you deal with this kind of a situation?
I think so. You can not predict everything, but what you can be is prepared, right? So you have to prepare well, which basically means that set the right expectations. It's never going to be at any point in time. It cannot be a smooth journey. It cannot be a journey which is investing is never a journey without volatility or what these drawdowns, right? So we know this, right? If that happens, what we will do, right? So be prepared around things like corrections or let's say lower single digit returns, which is where we are for the last couple of years, right? And all the long term story is intact, right?
Correct.
If you keep buying when prices have not gone up, you will have more units, eventually your compounding equation will go up, rather than, there's this standard example a lot of people have said that if you start investing today at a 10 rupee NAV and it quickly goes to 20, you'll be happy in the short term but not in the long term, because you don't have any enough units. But
Correct.
when it gradually moves, or maybe better if it goes down to 7, 8 and then it goes to 20, probably you'll make more money in that phase. Right? You can do this on an Excel sheet or something. The 10 ka 11 hua, 12 hua, 13 hua, aisa kiya. Let's say whatever period.
Correct.
You'll make more money, or you'll
progression.
make more money when the 10 rupee NAV goes down to 7, then goes back to 10 again, then goes to 11, then goes back to 9, and then eventually goes to 20. So where will you make more money? So please articulate all of these things to the customers when they invest. I think so. Being prepared, having the right expectations, right, is what you can do beforehand, right?
Okay.
And like same aircraft example, right? They will tell you this is where your this open this that there is
this is the place where they
whatever the safety grind, right? It's meant for that. It's for the it might come handy, right? It doesn't ever.
Yes.
But that's what you do. You are prepared, when if that happens. So if you do that well, clients will probably, listen to you when it happens. Setting the right expectations, setting the right tone. What is the role? What is your role? What is my role? What can the journey be, right, from here to next 5 years, 20 years? So be prepared about things. Be articulate that. Don't be in a hurry to close the deal, to invest money.
Handhold them, make it a point that these are the safety measures, these are the checks and balances, this is how it's going to perform.
It's the nature of the beast.
Yes.
Yeah.
Nature of the beast. Oh wow, very, very well put.
Yeah.
So can I actually say that all these PMS holders are psychologically built differently? Do you agree to that?
No, I think somebody who has more money is probably more resilient to short-term movements.
Okay.
When you have little, you tend to be afraid more.
Yeah.
If you have enough of something, then you are more patient. You don't mind losing some of that, right? So it's more of clinging on to the little that you have versus when you have it a little more, then you're not worried, right?
Yeah.
So people who have more money tend to be a little more smarter, a little more patient, a little more less worried than somebody who has less money. Yeah.
Okay. Now, a very, very business-oriented question is my next one. I don't want you to take the name of the investor. Give me one example where the investor wanted to invest in mutual funds or insurance products, but convincingly, one of you MFD or you diverted him to PMS just because that was the right product for him, which most of the time customer may not agree to it, but then still over a period of time he realized, yes, you have directed him right.
So PMSs are of three kinds today. There is an equity PMS, there is a debt PMS, there is a REIT InvIT PMS, right? Now, like I said about debt earlier, debt funds tend to stick to AAA rated bonds. If you buy a debt PMS, they can invest in A minus, whatever. They can go down the ladder of ratings.
Right.
So somebody had, many times, I would say, not one or two times. They had money, they wanted to park it in debt. They didn't know about a debt PMS or a debt AIF, right? There's something a long short in equities as well, right? Where somebody is trying to generate arbitrage plus 2% returns with a track record from 2018.
Oh.
Yeah, so you don't divert it. You basically enlighten them about options they might not know of.
Okay.
Right? So we're
that's the important thing.
Not diverting in that sense, right?
Yeah.
I have no, like I said, there is no favorites among these, right? Ingredients. Like, you have to see which one suits where, what does the customer want. But there are things which people would not know of because they are not from your industry. So yeah, that's your job, to enlighten them about a better option. So the founding idea on everything that we do is, can we generate 2-3% more returns for this customer? And based on whatever he knows, can I top that with my knowledge and generate 2-3 more? So you can be at an X knowledge, X, in terms of thinking, right? Can I top that and still generate 2-3% more for you? Wherever you are today, you can be at 8, can I generate 10? If you can be at 10, can I generate 12? You can be at 15, can I generate 18?
Okay.
Yeah.
Wow, nice. So this is the last thing that I wanted to ask you from this chapter. Uh, PMSs have shown 40, 50, and in some cases 70% return over a period of time. Now, with the beating the benchmark by over about say 8 to 9 percentage benchmark returns. So this is huge alpha with the traditional products and the mutual funds that we are talking about. Now, tell me, is this alpha is clearly the genius of the fund manager, or just that golden touch that happened accidentally? How do you define this?
So, like I answered earlier, incentives and ownership. I think so. The answer is in these two words,
Okay, incentive and ownership.
right? There is a tangible, like I told you, performance fee, right?
Yes.
The manager will get more fees, they generate more alpha, right? Which is a tangible difference between a mutual fund and a PMS, right? So one reason is that. The other is ownership, right? So they are owners today of that firm. They're not an employee of the previous organization. They own the firm.
Okay.
So they tend to be more passionate, like
prudent.
अगर मैं किसी और की इनोवा चला रहा था उबर में कि किधर, तो मैं थोड़ी इतनी मेहनत करूंगा वर्सेस मैं खुद की इनोवा ले लूं. I'll of course work harder. This is my car now, right? I have to pay the EMIs. So I think so, ownership and incentives. I think so.
So that's what makes the alpha.
That's why, yeah.
Yeah. Wonderful. So this is what's the now footnote to all my investors who are listening, especially to the MFDs. Funds India has a standardized format to cherry picks the best PMSs, and also there are incentives for MFDs who wanted to sell PMS, and also there is huge amount alpha available for investors. The fine line that you need to draw between mutual funds and PMS is here. Please get in touch with Funds India advisors and get your PMS right. Thank you. Manish, we will now move into the third part before Manish ki baat. So this is about alternative investment funds. One of the most complicated, most misunderstood product in India. This is part of the wealth ecosystem, but somehow understanding its classifications like category 1, 2, 3 becomes slightly difficult for a common investor, and more importantly so the ticket size, which starts with 1 crore.
Yes.
Now, before the nitty-gritties, let me just give you a scenario. One of my investors wanted to invest 1 crore each in all 3 categories. And can you explain it to the audience how this each crore going to perform?
So we'll stick to category 2 and 3.
Okay.
Let's just ignore category 1 right now.
Okay, fine, fair enough.
So category 2 is unlisted equities, private credit, real estate, right? 3 things broadly. Right? You can have a fund which will invest into unlisted equities.
Okay.
You can have a fund which will invest into private credit or performing credit, right? Have a fund which will invest in real estate.
Okay.
And there are variants. It can be a mixture of all 3, stuff like that, right? Cat 3 is listed equities, right? But you can do long short. You can have some bit of unlisted as well,
Okay.
right? In Cat 3. So I mean, these are the, let's say, four things that we can talk of.
Okay.
That what does a Cat 2 unlisted equity AIF do, right? And what does a private credit do? What does a real estate one does? And what does the Cat 3 do? I mean, so we can talk about all the four, and there are tangible differences in terms of regulation. So first of all, any product, when you compare it with, let's say, if you want to talk about mutual funds and AIFs, right? Same firms launch both the products.
Correct.
Every asset management company, mostly everybody, right, has an AIF in some form or the other.
Okay.
Right. Today, HDFC has a structured credit AIF. They had a AIF FOF, which was Cat 2. This is Cat 2. Right. If you look at private credit, so many of, I know of 7 of them which are open raising money. Right. So there are these 4 categories. Now, they have no overlap. The regulation is different, right, than a mutual fund product, right? It's regulatory difference, right? And they invest, let's say, a Cat 2 unlisted equities will invest in unlisted equities, which is not available in the mutual fund space.
Okay.
So there's no, so regulation wise, it's different. Where it is investing is different.
Yeah.
So again, like I said, it's not an either or product, it's an and product, and it's a function of whether you have enough money to buy all the 7-8 things, right? So, AIF, PMS, Gift City, NCDs, mutual funds, SIFs, right?
Yes.
If you want to buy all of them, you should have that kind of money.
Correct.
Which is like saying that I'll cook a meal with 20 ingredients because I have money, and if I'm poor, I'll cook it with 3 ingredients. That's fine. Right? But it is one of these ingredients. It is no overlap between a Cat 2 AIF and a mutual fund scheme.
Okay.
There's no need to compare them because they're very different.
Very different.
But you have to look at, if you are an investor, you have to look at them as ingredients of how do you want to manage your money.
Management. Yes.
So Cat 2 unlisted equities, private credit is, again, let's say, what are these credit AIFs, right? If you are a borrower, right, you can go to a bank, you can go to an NBFC, or you can go to an AIF, credit AIF.
Okay.
Right. Now, you would think that the worst kind of people would go to an AIF because they can't get money from a bank, they will go to an AIF, right? That's not true.
Yeah, popular belief is that.
Let's just first stay on the point that so what came first? Did banks came first in India or NBFCs? The answer is banks, right?
Yeah.
Do banks have more branches than NBFCs? The answer is yes, right? So in spite of so many nationalized banks, private sector banks, why are so many NBFCs so much successful? Bajaj and so many, right?
Yeah, I know.
Spectacular successful, right? The answer is again in regulation. RBI has separate regulations on banks, separate regulations on NBFCs, and separate regulations on, let's say, AIFs. If you are a borrower, who is likely to be the most flexible lender of capital to you? Flexible, not the cheapest.
Okay. Yeah.
Right? It's going to be AIF. So if you want flexibility, right, and if you don't mind paying a little more, right, you would go to an AIF. Now, if you are an entrepreneur, let's say you run a manufacturing company and you want let's say 100 crore loan, right? If you go to a bank, probably they would need tangible collateral, tangible security. They will need an EMI. They will need interest at certain times. And if you go to an AIF and if you say, I will not pay you anything for the next 3 years, I'll just pay you at the end.
Yeah.
And I want money to buy land, right? I want money to buy NPA assets. These are things for which banks and probably NBFCs will never lend you money because of regulation. So you want more flexibility, you don't mind paying more. You are an entrepreneur, you know how do you make more money.
To turn it around.
Yeah. So that's why all of the three will thrive in India, right? And that's what a credit AIF does in short. It's much more complex than that, but that's what the gist of that is. And let's say the real estate. What can you buy? Can you, let's say, if you have a crore of rupees today and you want to invest that in real estate, how many houses or shops will you be able to buy in Bombay, right? Probably one, probably two,
very true.
right? But you will not be able to buy 10 projects in 10 different cities in India, right? So again, like economies of scale, right? In mutual funds, you put 10,000 rupees, you own the best 50 companies in India.
Correct.
In the same manner, if you put that 1 crore in a real estate AIF, that AIF will be able to diversify that into 10, 12 projects across 10 cities in India.
Wow.
So it brings expertise, it brings economies of scale, and it brings an asset class in financial form to you.
Correct.
Right? You don't have to worry about tenants or exits, or that is none of your worry, right? So it really simplifies your life. So those are the three things a CAT 2 AIF can do. No some comparison with mutual funds schemes. Right?
Yeah.
CAT 3 is listed equities. That is where probably you would think that why do I need a CAT 3 versus when I have mutual fund schemes, when I have PMS.
Because of the derivative factor?
No, I don't think that's just derivatives. It's a bunch of things. Like I said, a PMS will have individual stocks in your demat account. There's no pool, right? There's no NAV.
Yeah, correct.
CAT 3 will have an NAV. It will have a pool structure.
Oh.
Right? And it can be an open-ended CAT 3, close-ended CAT 3, right? It can invest in sector stocks. So the limits which apply to mutual fund schemes, they don't apply there. So it on regulation wise, it's tangibly different.
Okay.
And it can be you can do things which you can't do in mutual funds. So let's just say that you can bet on sectors, stocks.
Yes.
You can put 30% in unlisted. So you can do a bunch of things there as well, right? Which is, and again,
very flexible.
Yeah, and again, the same guys. If you remember, the biggest people in the mutual fund industry are running an AIF PMS firm today, and not a mutual fund firm today.
Okay, they all started with the mutual fund and they ended up in PMS and AIF.
Yeah, so that's the structure which they are more comfortable with.
Yes.
And their clients are more comfortable with.
Yeah. So the apt use of the intellectual property they created over a period.
So there are tangible differences in regulation, in fees, in performance fees.
Yeah. It's a win-win situation basically.
Yeah.
Okay. So now I wanted to ask you, there are enough AIFs in the industry. If one of your investor has to choose, what are the SOPs that you follow to give him the right AIF? He has money and he's ready to park it for 7 years or 8 years or 10 years even. What will you do with that?
So, manager selection comes later.
Okay.
Right? You don't have to, go there directly. You have to first say that, let's say, to answer your question more in a better way, let's just say that somebody has 5 crore rupees. Let's just say 3 crores, right? First of all, you have to ask, what you have to do is asset allocation, right?
Correct.
What percentage of that money should be in real estate, should be in debt, should be in commodities, should be in listed equities, should be in unlisted equities, should be outside India. That is the real thing that you do, right?
Well. Okay.
Then within that, let's say now I want to invest in some portion, I want to invest in unlisted equities, right? Now, those funds are not open-ended funds, right? All AIFs,
it is
they raise money, then they close, right? So you have to see which ones are open today. And then like you do with mutual funds, everybody who is managing them has a track record, has a pitch deck, has a process to select companies. You go through all of that.
Okay.
And then you select the best according to your ability. But I don't think manager selection is that, it's equally important, But I think so. The first thing is a little more important, that how do you allocate within all of these things, right? Right now, people just think of, because they are mutual fund distributors, they would think just of debt and equity. I don't think they also think about debt and equity. They just think debt, equities, right? And within equities, what they think is, ke lump sum kar do, ke STP kar do. So there is no asset class for a mutual fund distributor. The only asset class is equities. If it is little scary, you do a STP, right?
STP. Yes,
There's no
yes.
asset allocation per se, right?
Yeah.
So, but the real thing is, you can invest in listed equities, you can invest outside India, unlisted equities, real estate, commodities, debt. Within debt, there are many variants, right? So, first answer that well, right? Why and how much?
Yes.
And I'll give you an example, and let me tell you what I think about that. 3 crores for the next 25 years. If you generate 7% returns on that,
Okay.
it will become 19 crores, right? If you generate in 25 years, if you generate 12% on that, it will become 51 crores. If you generate 18 on that, it will become 190 crores. And if you can generate 24 on that, it will become 650 crores.
Okay.
Right? Now, my sense today is that to generate 7 or 12, do I need an agent or an advisor, or do I need an execution platform? The answer is, I need an execution platform. I don't need an advisor to generate 7 to 12% returns. But if I want to generate more,
Yes.
and if this is my universe of 2,000 products or manufacturers, 50 mutual fund companies, 500 PMSs, 1,000 AIFs, then I will not be able to do it on my own, or Claude will not be able to do it for me.
Okay.
Right? So, that's the value that you bring to the table, to the investor. You can go through all of that and
Probe
in
and
a way,
find the right.
in a way, churn the ocean to find those pearls. That's what you do.
Wow. Wow. Very, very beautifully you articulated that. Basically, what you said is, in nutshell, you need quality advisors to probe and pick the right product.
If you have an advisor who thinks 12 is enough,
Then there is a problem.
then you have the wrong advisor.
Yes. Yeah. At various occasions, I told my investors as an MFD, and if you are looking for safety, I think you better be safe with a bank manager than me. So they get offended. I completely.
No, I mean, this is maths. I think so, nothing is guaranteed. 7 is not guaranteed for the next 25 years. So is 24 not guaranteed for the next 25 years. But, you have to learn. You have to be at it. You have to find, you have to upskill. You have to be at it. You don't, देखो एक जमाने में लोगों को ये लगता था कि अरे इक्विटी में से assured है क्या 15% आएगा 12% आएगा. People used to talk like that. All the insurance agents used to talk like that.
Yeah.
उसका DO उसको बोलता था अरे तू तो डूब जाएगा ये वो. Today people will be equally skeptical about NCDs, AIF, PMS, GIFT City, right? Because it's new.
Yes.
But I think once you learn, once you experience, I think so. And what happens then is that now 12 is your benchmark. 7% returns was your benchmark 20 years back.
Yeah.
Now everybody thinks 10, 11% is the benchmark.
Correct.
Now then, you have to learn to generate 16, 17. Can't stay at 12. Everybody's at 12.
Okay. Come out of the langar party.
Yeah, so I mean, Claude plus couple of ETFs, you will be able to generate 12% return. Why do I need an advisor for that?
Very true.
Yeah.
You need to scale up.
Yeah, as an advisor, you have to really keep learning. 7 से 12 सीख लिया, 12 से 14 सीखो, 16 सीखो.
Okay. Now, this is in this chapter. This I will consider as a last question. Give me a 90-second pitch for an MFD who's never sold AIF. Should it make it to the next product in his basket? No jargons, a candid statement from you and no disclaimers also.
Of course, the answer is yes.
Okay.
And I would say that, like I said, HDFC, right? उसका दो प्रोडक्ट है अभी, राइट? एक क्रेडिट AIF, स्ट्रक्चर्ड क्रेडिट, विच इज नथिंग बट एन क्रेडिट AIF, और एक FOF जैसा, दिस इज एन CAT 2 unlisted equities product or an FOF, right? You will not sell that. I mean, as an MFD, that HDFC is launching a product, which has already collected, let's say, 1,500 crores in the previous product. It has a track record, and they have a vision of why this product will work, what kind of investor. You will not listen to that. You'll just sell HDFC FlexiCap fund. Why would you do that?
Yeah. Logic.
Why would you say no to the same AMC for the other two things? For what?
Yeah, with such a huge track
No,
record.
it's not just HDFC. I mean, ICICI has a bunch of all of these products. I mean, and it's a matter of time. Every AMC will have a bunch of all those products. Why would you say no?
Very true.
Yeah.
You need to open up and see.
You need to learn. You keep learning.
Manish, this is the final part. In this, there are two sections. One is Manish ki baat, and second is a rapid fire. And I am very sure you are very famous and very good at that. So first, I'll consider the Manish ki baat. So your personal transition from a traditional setup to a tech-first B2B platform. What are your USPs to consider this is your next big calling?
I don't think it's a tech play. I mean, tech is always an enabler in what we do, right? I think so. More of that. It's more about, stretching yourself beyond what you've already done well, right?
Okay.
So to give you a small example, when I moved to Bombay with NJ 2005, we had about 30 crores of AUM in Mumbai at 30 distributors, right?
Okay.
23 when I left, it was 50,000 crores, probably 60 today,
Okay.
right? So I think so we did that really well. And once you do something really well, you get bored of it. You've done enough, and you want to do more.
Yes.
So in version 2.0, I mean, what I want to do is, like I said earlier, really not limit myself
Okay.
to just one product. And I think people who do that are mis-selling in a way, because you're not really educating people about everything that an AMC is doing today, the same AMC, right?
Okay.
It's the same AMC has a gift city offering, an SIF, an AIF, maybe a PMS, maybe has a passive index ETF bouquet, and they have active mutual funds, and they have debt funds, right? Of these 7 things, right, you sell only one, right? I don't think that is the right thing to do. What I want to do right is, again, think of these as ingredients and create portfolios for customers which generate better returns, better risk-adjusted returns, lesser volatility. So if you not limit myself to just one of those 7 products, how do I bring all the 7
under one umbrella?
Yeah, how do we use all of them in the right proportion so that our returns for our customers go up and the risk probably goes down?
Okay.
Yeah.
So the next thing is it's more to do with your persona. Now Funds India is taken over by Westbridge, and it's managed by Ivy League personalities. Very, very good one. How do you fit into that kind of a setup? And what is your inner feeling when you're working with such bright people?
I mean, I've always worked with bright people throughout my life. I mean, all my previous bosses were like super duper bright. I think so, I mean, the Ivy League, education, private equity, right, versus some homegrown talent. I think so. I'm lucky that I've seen both those spectrums, right? I'm working with the other spectrum now. But all of them were equally smart, equally passionate, right? Helps me in the sense that I've seen the whole spectrum. And it's always a privilege if you are surrounded by people who are passionate, smart, they have the heart and their minds at the right place. So I've always been lucky. From 2003 onwards, I've had amazing colleagues, amazing bosses. They were passionate, and that's why whatever happened. It's because of that energy. So I'm lucky to see a different world now, which is equally passionate. There are small differences, but I don't think that really it's such a big change. I think so. It's everybody wants to do the right thing. Everybody wants to build for scale, right? I'm lucky to see.
Okay. So for Funds India, being the CEO, what are your bigger plans? If you can enlist some of them for the benefit of the MFDs who wanted to join you.
There are no bigger plans as such. There's a better plan, I think I would say.
Okay. Yeah.
I think, like we spoke about previously, right? People are stuck with a mindset, and this is no different than 2003 when the development officer of that insurance company was stopping this MFD from starting a mutual fund business. Risky hai, डूब जाएगा पैसा. It's the same story again.
Okay.
Just the product has changed. Right now, your comfort product, at that point in time, your comfort product was post office and insurance policies. Now your comfort product is mutual funds, SIPs, and you don't want to stretch yourself. So we will help you make that transition, right? We will help you from just being an SIP agent to be a true wealth agent, right? Or a wealth distributor, like a wealth farmer, right?
Okay, thank you.
Not just an SIP agent, right? And it's not easy, right? You will need the right hand holding to do that well.
Yes.
And you will have to trust our team, because our entire team is people who, like me, who spend our lives helping MFDs grow bigger and bigger.
Correct.
So we have people who have just done that, like me, just one job, right, of helping MFDs becoming bigger, better. And we want to build a platform where MFDs were very serious about the next 10 years. There are people who have reached a certain size and are happy and want to be happy. Probably play golf, hang around with friends. Right, we don't want to work with those people. We want to work with people who are still hungry. We want to work with people who want to generate 3-4% more alpha to their investors, and product curation, research, tech. We will help them scale. Like one maths which I will tell you is that if you work direct or with some other platform, you will have a 50% lesser value. Your business will be valued 50% lesser than what it would be with us. Wow. So if you create a company whose value, let's say, with us, that company's value will become 100 crores the next 10 years. If you don't work with us, probably it will be valued at 50.
Okay.
So if you want to double the value of your firm, you will need partners like us. And, we have the right people to, so we've learned, everybody has learned from other people, other previous organizations, what not to do, right? Yeah. And we've seen enough people trying to attempt this and, learned enough from other people's mistakes. So we'll build a platform where client comes first, right? The client's returns, risk should go down, returns should go up.
Okay.
It should be multi-product. There should be no biasness towards asset classes or products, right? So right now, most MFDs are equity biased and mutual fund biased.
Correct.
And that's a bias, right? They don't know enough of the other world to comment on that. Forget knowing that, right? So they can't comment. They don't know. People who has never sold NCDs will have no right to comment on anything. Right?
Absolutely.
They have no first-hand experience of any of those things, right?
Very true.
So don't be biased. right? Let's look at everything. Let's look at all the ingredients that we have in our kitchen, so to speak, right? And try to create the best dish for our customers, right?
Okay.
And you will need help, because as an MFD, I don't know what kind of due diligence you can do on these 500 platforms, whether they will even allow you to distribute their products, right? Whether some AIF will even allow you to distribute. So giving you not just access to those products, right? But also trying to curate the best of that world. And it's not easy,
Okay.
right? And I'll tell you why it's not easy. If I bring 50 PMS managers to you or to some investor, and they all spend 1 hour with you or some investor, do you have the capacity to really say who's a good guy, who's a bad guy?
Oh, no,
Probably
absolutely
no,
no.
right? So you need somebody who can do that well.
Yeah. Right.
Right? You should know, you should have a team. So like most MFDs, you can be at 500 crores AUM. But if I ask you how many people do you have in research, the answer is zero.
Yeah, it is.
And if you tell this to all your customers, कि boss, मेरा 500 crore AUM है, but research में मेरे पास zero आदमी है, what would your customers think of you, right? But if you tell them that I am a part of Funds India, where there is a 30-member research team
Yes.
on all of these things, and it is our job to churn the ocean and find those pearls for you, you will look better off where? On your own or with us, right?
Yeah.
So the lone wolf dies, the pack survives, right?
Yeah, pack
So you
survives.
want to be a part of the pack, welcome.
So this is the place where the pack is.
Yeah, so I mean, we try to build that company where investors come first,
Okay.
right? You'll be surprised that there are not many such firms in India. They might, everybody says, बोलते सब हैं कि नहीं client first and all, but we all know what they do, right? And so build that first. I think problem is not that MFTs don't understand that, and I'll give you an example from the previous example, right? If the client earns 12%, you earn trail commission on 51 crores after 25 years. But if you are able to generate 18, you will earn it on 190. So really that is not a problem. If you do well for the client, it automatically means good for the MFDs, right? So probably, when you are just selling distributing one product, probably you would have, it's you scaled to, let's say, 500,000 crores away. Maybe you didn't need much help.
Yes.
Because, the processes and whatever MFI has done, it's super standardized, right? You have 2 RNTs, your life is solved. You have MF Star MF and NSE platform. So it's really easy. But when you want to do this across 6 other products from the same AMC basket, right? It's not going to be easy. And, the other thing is, within mutual funds, right? Clients today just look at their returns, 12%, 13%. They're happy. They don't know what benchmark returns are. So if I tell a customer that your returns are 12%, they'll most likely be very happy. And if I say the benchmark is 14, most of them will say, what does that mean?
Correct.
They don't know, right? What that means is that if you paid, let's say, 1.80 as an expense ratio to generate 12% returns, right? And if the benchmark is generated 14% returns, and the expense ratio is, let's say, 10 basis points. So you paid 18 times more.
Correct.
And that's why you got 12% returns. That's why you got 2% less, right? People will understand that someday. People don't understand advisor alpha. Means we have a model portfolio of mutual fund schemes.
Yes.
Which has
5-finger.
Yeah, it's called 5-finger strategy.
Yes.
Which has delivered an alpha of 4% over, let's say, NSE 500 or flexi cap funds, right? Now, people don't know that. People don't know their lifetime CAGR, right? So with education, it will become progressively tough to avoid, let's say, passives, to, what are the three, let me just, tell you what the three headwinds are for the MFD business, right? You have competition from direct DIY platforms.
Yes.
You have the TERs of all the active schemes keep going down because the size of those schemes keep going up. So while your AUM can go up, you can still be at the same income.
Yes.
Right? Because the TER has gone down. So you are running in this direction, the AUM is running in this direction, the TERs will run in the reverse direction.
Yes.
That's another challenge. The third challenge which will come up is passives. Right? People will ask questions on that, and currently I don't think anybody sells passives or index or ETF funds. Right?
Yeah, much lesser.
Yeah, very few. So to navigate these three things going forward is going to be a problem. So we can help, basically. Like I said, if you have a pack, you do well. If you are a lone wolf, probably you won't. And we have our heart and mind at the right place. We are customer first. We don't have any manufacturing clash of interest. A lot of other firms, they tend to have their own manufacturing arm, like their own AMC, their own PMS, AIF division, and there is a clash of interest. What do they recommend? Do they recommend outside products or they recommend in-house products?
Yes.
So we are a true blue curator of the best there is, with no clash of interest. That's what we want to be.
Manish, there are about 150,000 MFDs present in India. Where do you see these numbers growing in a world where there is cloud and DIY, direct? And what is there in store for this MFDs who wanted to take up this as an entrepreneurial venture?
So more than that, I think so. There was a news article some days back that there are just 13,000 people in India greater than 25 crores of AUM. Only 13,000.
Okay.
Right? If I'm not wrong, the number of ARN holders who are KYD compliant is just 75,000. Right? But only 13,000 people with AUM greater than 25
crores.
And if you look at other platforms, that number can go up by another 3,000, 4,000 people, right? So it's just 17,000 people. There are banks in India who have 17,000 branches.
Oh.
Right? If you look at insurance industry, it has 24 lakh agents, or, they keep creating another 6-7 lakh agents a year. So there's ample of scope for many more people, I would say. But it's challenging in the sense that most of the current large distributors, right, have built their base in an era when there was upfront, when there was entry load. So if you don't remember, you used to get 8% upfront commission in NFOs. And that helped a lot of people scale their business because you need upfront revenue.
Yes.
Now, when you take that off, it becomes really challenging for a normal person from a normal background to just survive on trail. So it's made it tougher for the newer entrants.
Okay.
The regulation has made it tougher for a normal. देखो गरीब आदमी नहीं कर पाएगा.
Yeah.
If you have some money,
you need backup.
और आपको अगले 24 महीने तक आपका इनकम नहीं बढ़ेगा ना, या फिर बनेगा नहीं, तो चलेगा ना, तो आप बन सकते हो MFD, प्योर म्यूचुअल फंड डिस्ट्रीब्यूटर, राइट? बट इफ यू आर नॉट फ्रॉम अ प्रिविलेज बैकग्राउंड, इफ यू आर पुअर, and you will have to sell insurance or something that will generate some instant revenue. So it's made it tougher for the next 13,000 people to really scale their business or become economically viable.
Okay, so you very well answered my next question, so I will not ask you that one. Now, in this Manish ki baat mein, the last question that I want to ask you is, it's hypothetical. I would like to have a technical answer from you. Consider I'm an MFD from Wayanad, Silchar, and Samba. And three specific points I've taken where mostly mutual funds have not been there. Though Samba I have clients, but still I've quoted that, but not from Mumbai. So if those people in these cities which are not in the Google Maps wanted to join this industry, how equipped are your platform to onboard them, service them, and also to take your products, your advisory to nook and corner of India?
When we have physical presence, which was not true, let's say, before I joined. But there are platforms we have zero physical presence, and they still do amazing job of training, motivating these MFDs from all over the nook and corner of the country. So can we?
Okay.
We believe that if the relationship is physical,
Okay.
it's likely to be more effective. It's likely to be more stronger. That's what we believe. Whether it's clients or MFDs, that's our
Yeah,
belief.
yeah, right. Yeah.
That's why we have branches. But distance doesn't really matter. Once in a while, if you can travel to the nearest metro where we have an office and spend a day there with our team, I think so you'll get enough energy for the next 30 days. And I think so some of those things that, webinars and Zoom calls, they don't really answer some of your, tougher questions. But an in-person interaction for, let's say, if you are in Silchar and if you can go to Kolkata or whatever is the nearest branch and spend a day with our team, I think so you'll come back with a much clear head and much
Yes.
clarity of what you want to do. So I would advise, please join us. Please be willing to travel once a month
Yes.
to our nearest branch, and we'll put in all the energy to make you successful.
So,
आपको भी कुछ करना पड़ेगा इन्हें सक्सेसफुल बनने के लिए.
Yes, yes.
सिर्फ ओनर्स हमारे पे नहीं है.
yeah, very true, very true. So this is what I wanted to tell all the MFGs who are watching us. There is a platform here under the guidance of Manish who's ready to come to you, provided you invest in yourself, you invest a bit of a time, bit of an energy, and then make use of this amazing platform to make a change in the lives of a lot of people who need you. So like what Manish said, Manish need your time. There are people living there who stuck at below 10% returns can have substantial growth with the help of you. Please use this platform and get in touch with Funds India team. Okay. Manish, going to the last part of this is a rapid fire. Okay, I'll read the questions and I'm looking at answers from your trademark punchy words.
I'll try.
Okay. If you have 1 crore to invest today, which one? NCD, PMS, or AIF?
No. If you have nahi, I have.
Okay, so yeah.
If you don't have, so I have couple of crores, and it's invested across on all three branches.
All of them you invested. Okay, now one AIF manager in India who consistently deserves their fees. Would you like to name them?
I mean, there are many, I would say, and this is not part of a normal MFD's world, so you would not know things about that. But a Cat 2 unlisted equity AIF in India collected 25,000 crores without having any distributors on their own. Because they are so big. So, even in India, there is a PMS firm in Mumbai, right, which had, 10,000 crores of AUM. Zero distributors. Because those kind of people don't need distribution, right? And nobody knows.
Their brand
so
speaks.
I think most of the guys who deserve their fees might be people who can fail at what they're doing, and that can be temporary. Okay. I don't think somebody is not doing their job well can be in business for a very long time.
Okay.
Yeah.
So the next one is, one NCD issuer you would never touch. You don't have to name them.
Right.
Just tell me the red flags.
Yeah. So I would say that, it's not one. I would say that even in existing ones, all the ones, a good guy can be wrong many times in his lifetime, right?
Yeah, right.
So it's not really
That is
being
human.
digital about this कि ये खराब है, ये अच्छा है, ये रात है, दिन है, black है, white है. Every issuance you have to do your due diligence on. Even if somebody has, experience has been great 11 times, it could be wrong the 12th time. So you follow your process every time. You don't, go get tinged by past performance.
Okay.
Yeah.
Right. Okay. Now next is you may not answer this if it is very uncomfortable. PMS limit is 50 lakhs. Should SEBI raise it, lower it, or scrap it altogether?
I mean, it's fine wherever it is today. I'm happy with that.
Okay, lovely. The rupee is at 95 and likely to touch more than that, probably 98 or anything. Is it possible or is it a paranoia?
No, I think so, though I'm not a forex expert, first
Okay.
of all, right? But the way, the currency depreciates against any other currency is probably differential in inflation between the countries. So India will probably see a lot of inflation this year. So it will depreciate more.
Oh, okay. You call for a depreciation.
That's my
Your gut call.
that's my assumption.
Yeah, hunch.
I can be wrong.
Oh, lovely. Oh, wonderful. That's music to most of the people, indeed. Now tell me, the biggest lie told to an HNI product sales meeting in one sentence.
We are client first.
Okay.
And most people lie about it, except us.
Okay, I get that. Okay. If a 35-year-old MFD currently having 25 crore AUM in mutual funds, ambitious, hungry, and as we speak, is watching us, is there. Okay. What is the single most important thing you wanted to tell them to do differently starting from today?
So the IFA, right?
IFA, yeah, right.
Like I said many times during our talk today, learn everything, get certified, SIFN as an exam, PMS as an exam.
Yes.
AIFs currently don't, but I'm sure it will be at some point in time. But there is an exam which you can clear too, so that you're up to date on stuff, right? But get certified, learn. If you have money, right? One of my favorite theories is that if the distributor themselves had 10 crores of money, of their own money, they would be fabulous advisors. The problem is that you are a poor advisor because you are poor.
Wow.
Right? And that's unfortunate.
Very unfortunate.
Right? But, if you have your own money, learn with your own money first and then go out and help other people with your own, with whatever you learned. And you can show them that your own skin into the game and, stuff like that with more conviction. But, we don't have people like that coming to the MFD industry to become MFD, somebody who has 10 crores. But I would love to have,
Such people.
Yeah. That because, some things you only learn by investing, right?
Yes.
If I,
that's taking the challenge head on.
Yeah.
Even after being wealthy.
Yeah. So the reverse of that is also true, that somebody has 10 crores and is not willing to learn. That is even more unfortunate, I would say.
Yeah.
That they are wasting the privilege that they have.
Yes.
Of learning and really upping them game, and that really wasting that privilege. Yeah.
Okay, so this is the second last question. What is that one legacy you wanted to be written in the Hall of Fame when you hand over the baton to the next generation?
I mean, I would. There are many Latin quotes which you can use, like "vini, vidi," and all that.
Uh-huh.
And you can say that I came, I saw, I had some beer, I had some fun.
I came, I
made,
saw, I had some beer, a
I had
wonderful.
some beer, I made some friends, I had some good laughs, I had some good days.
Okay.
I mean, nothing extraordinary. I mean, I don't want to be. I want to have a normal life.
Okay. So you're already in the Hall of Fame and you are a person to be around and reckon with. And I know that for sure. So the last question. You have seen the wealth management industry from the inside out, NJ India to Funds India now. Are we, as an industry, truly working in the client's interest? You mentioned it many times in the earlier conversation. Or are we still a dressed up distribution system just for our own stomach?
No, I would strongly disagree with what you said in the latter point. I think whatever we have achieved, the mutual fund industry, right, is phenomenal, right? Today, FIIs have been selling for the last, 2 years. Market is rock solid thanks to SIPs.
Yes.
Who made SIPs famous? We,
Yes,
right?
indeed.
So our contribution is not just to our investors generating 12, 13, but it's to the nation, right? It's helped us through this turbulent time,
Yeah.
right? And it could
Befitting
it
reply
could
to
have, could have,
FIIs.
it could have been a chaos if you didn't have this kind of SIP book that we have today. Who built that? We all built that, right? So credit goes to all of us,
Yes.
right? And the other option to that 12, 13% return was fixed deposits or insurance policies. So we created wealth for the customer, we created wealth for the nation. So I think we should give ourselves a pat on the back for whatever we achieved. And I think so. Never get there are some rotten apples in any farm or any basket. I mean, that's fine. Broadly, we've done a good job. Can we just bask in that glory? No. Should we keep sharpening ourselves, keep working harder to generate
humble.
better return? No, keep getting better at what you do. Can we generate 14? Can we generate better returns, better risk adjusted returns? We'll keep at it, right? Not get tired of, just because you've done one thing well,
Yeah.
that doesn't mean you should hang your boots, right? You should keep learning, keep working hard. Yeah.
Thank you, Manish. It was wonderful having a conversation with you, and it was enlightening as always.
Thank you, Anthony, for Wealth Farmer. I don't know what you should say, but thank you, Anthony, for inviting me. Always
Yes.
been a friend and a
Yes.
fan all the time, and see you around.
Thank you.
Thank you.